In today's video, we are diving into a powerful market message from Tom Lee that every investor needs to hear right now. Tom Lee, the head of research and chief investment officer at Fundstrat Capital, recently joined CNBC's Closing Bell to react to the president's latest comments, growing market fear, and the possibility of a bear market later this year. And despite all the anxiety in the market, Tom Lee is making a bold statement. He believes this wave of fear may actually be the buying opportunity of the year. I'm going to show you the exact clip of Tom Lee from the CNBC interview so you can hear his words directly. After that, I will break down what he really means, explain why his message matters for everyday investors, and share my own reaction to his outlook on the market. After that, we will go deeper and look at two of the most compelling tech stocks that could benefit from the current market setup. Hit the like button, share the video, drop your thoughts in the comments, and subscribe to the channel so you do not miss the next important investing update. Now, let's hear what Tom Lee has to say.
Joining me now is CNBC contributor Fundstrat's Tom Lee. Tom, it's great to have you react to the president and what's happening in the market. So a framework to a deal, no force, all is well now for the bulls?
Scott, I think so. You know, I'd say on Monday morning before the open, I think investors were very concerned about Greenland and what's happened in Japan. And they thought of 2025 when it took 8 weeks for stocks to find their low, down 20%. So I think there was a lot of fear. So today's news really does do a lot to diffuse a lot of that anxiety. And I think it's wise to buy that dip.
Yeah, I mean, as part of this, of course, the president also saying no tariffs on Europe on February 1st. And that's what really upset the market. Are you still looking, though, Tom, as positive as you might sound for a bear market sometime around mid-year?
That's right, Scott. I think we have been pretty clear that we think that there is going to be a mid-year hiccup. It could be around policy or it could be around the new Fed being challenged. But that's coming from us markets being at a higher level. And I think one of the mistakes people make whenever they hear that commentary is they think it means to go to cash. Now, as you know, we've advised to stay invested and to buy the dip. But yes, there is a lot of good taking place in 2026, but we do have a lot that's already been priced in because of 3 good years of market gains.
What dip would you be buying specifically?
Well, for instance, I would be buying the dip on companies that have good earnings visibility or a structural reason to be long, because those that got sold yesterday, for instance, they're still the same great company. They were just 10% cheaper. I mean, to me, that's a stock I'd want to buy. The names I'd want to avoid are companies that are in the bullseye of White House policy, because we know last year the White House picked winners and losers. It created problems for healthcare and consulting companies. This year it's credit card issuers, institutional buyers of single-family homes, and that's some countries too. So I think that's the stocks to avoid. But I think fundamentally strong names, you still want to buy the dip.
I mean, it's complicated though. You say that you don't know who's in the so-called bullseye next. That's one of the problems.
100%. You're right, because if the White House decides that there's a company or a series of companies that are creating problems for Americans right now, whether it's credit card bills or electricity bills, there could be action. As you know, one of the potential, quote, risks is data centers and their consumption of electricity. So that is something to watch.
I mean, you're gonna say, don't buy the home builders, because what if the home builders, he doesn't like home builders building homes and charging the prices they're charging? I'm just saying it's a slippery slope to start going down, where, in your words, you have an administration picking winners and losers. It certainly complicates the picture a bit, doesn't it?
Scott, I mean, every administration picks winners and losers. Tom Block, our policy strategist, has pointed out that's what Washington's habit is, that they tend to pick winners and losers. But we do have a White House that is quite ambitious. They've accomplished a lot, but they're trying to accomplish a lot. So you're right, that's the risk. And perhaps one of these is enough of a tipping point to cause a broader pullback in markets. I mean, that's another possibility for why we'd have a drawdown that feels like a bear market.
But you still feel as though whatever upset we see or feel is going to be reversed and we end up having a pretty strong year?
Yes. In 2025, that 20% decline did not lead to a recession. And as we pointed out, that since 1950, waterfall declines that are not followed by a recession, and particularly a VIX hitting 60, have been symmetric recoveries. So I think if we have a, 6-week drawdown, investors shouldn't sell, because unless they're great at timing, we can recover all of that loss within 6 weeks. And we are expecting a really strong finish for the year. So
Tom,
I think it's just...
Where does the Fed factor in to all of this? You heard the president with his obvious criticism of the current chair, Jay Powell, and some commentary on where the next chair may come from. How much does this matter to your outlook?
It's important, Scott. The Federal Reserve is the single most important entity in the world, and its independence is incredibly important because markets respect the Fed and they actually fear the Fed. So the independence matters. I think the process, and Steve Reisman made some good points, I think we're at odds increasing that it's a Fed that'll be respected because the multiple things taking place at the Fed now kind of limit how the White House can proceed to pick the new Fed chair. And actually, that's probably a good thing.
This video is really about understanding how markets react to political headlines, policy uncertainty, and fear, and how investors like Tom Lee think through those moments when emotions are running high. What you just watched was not just a reaction to breaking news from Davos, but a window into how professional market strategists separate short-term noise from long-term opportunity. Right after President Trump spoke, the market reaction tells you everything you need to know about how fragile sentiment was going into that day. According to Tom Lee, investors were already extremely nervous before the market even opened. There was anxiety around geopolitical issues like Greenland, concerns about what was happening in Japan, and lingering memories of previous sharp market drops where stocks fell around 20% and took weeks to find a bottom. That kind of memory matters because markets are driven as much by psychology as by fundamentals. When people remember pain, they tend to overreact at the first sign of trouble. Tom's point is that the announcement of a framework to a deal and the confirmation that no force would be used did a lot to calm those fears. In his view, that single headline removed a major tail risk that investors were pricing in. I agree with him here. Markets hate uncertainty more than bad news. Once clarity shows up, even if it is not perfect, money tends to come back in quickly. That is why he frames this move as a classic buy the dip situation rather than the start of something more sinister. What is interesting, though, is that even while sounding bullish in the short term, Tom is very clear that he still expects a major hiccup later in the year. This is where many investors get confused. When they hear someone say bear market or major drawdown, they immediately think it means go to cash and hide. Tom pushes back on that idea very strongly. He argues that the market can experience something that feels like a bear market without it turning into a long-lasting collapse. From my own perspective, this distinction is critical. Some of the biggest mistakes retail investors make happen when they treat every correction as the end of the world. Tom believes the potential drawdown could come from policy mistakes or challenges to the Federal Reserve's independence. That makes sense when you consider how elevated markets already are. We have had 3 strong years of gains, and a lot of good news is already priced in. When expectations are high, it does not take much to trigger a sharp pullback, but a pullback from high levels is very different from a structural breakdown of the economy. When he is asked what dip he would actually buy, his answer is very disciplined. He focuses on companies with strong earnings visibility or structural reasons to exist long-term. His logic is simple. If a great company sells off 10% because of macro fear, but nothing about the business itself has changed, that is an opportunity. I personally agree with this approach. Too many people chase stories instead of businesses. A temporary price drop in a fundamentally strong company is not a risk, it is often a gift. At the same time, Tom is very clear about what he would avoid. He warns about companies that end up in the crosshairs of White House policy. He points out that in previous years, certain industries were effectively punished by policy decisions, and this year could be no different. Credit card issuers, institutional home buyers, and even certain countries could find themselves targeted. This is where investing becomes more complicated, because policy risk is harder to model than earnings or balance sheets. Even the interviewer pushes back and highlights how slippery this can get. If the government can decide one day that an industry is a problem, then suddenly any sector could be vulnerable. Tom does not deny this. In fact, he agrees completely. He acknowledges that every administration picks winners and losers, but he emphasizes that this particular White House is very ambitious and very active. That raises the risk that one policy move becomes a tipping point for a broader market pullback. From my own point of view, This is one of the most underappreciated risks in today's market. Investors often talk about interest rates and inflation, but policy activism can quietly reshape entire sectors almost overnight. That does not mean you avoid the market, but it does mean you need to be selective and realistic about where political risk sits. Despite all of these risks, Tom remains confident that any major upset would ultimately be reversed. He brings up historical data, showing that sharp market declines that are not followed by a recession tend to recover symmetrically. In simple terms, what goes down fast often comes back just as fast. He warns investors not to panic sell during a 6-week drawdown, because unless you are exceptionally good at timing, you might miss the entire recovery. I strongly agree with this. Panic selling is one of the most expensive habits an investor can have. He also expects a strong finish to the year, which reinforces his broader message. Volatility does not automatically mean a bad year. Sometimes the messiest years end up being the most profitable for disciplined investors. Finally, the conversation turns to the Federal Reserve, and this is where things get really serious. Tom calls the Fed the single most important entity in the world, and that is not an exaggeration. Markets both respect and fear the Fed, and its independence is crucial. Any perception that the Fed is becoming politicized can create instability, even if the underlying economy is fine. In my view, this is the quiet backbone of Tom's entire outlook. As long as the Fed remains credible and respected, markets can absorb policy noise, political drama, and even sharp corrections. If that credibility is damaged, everything becomes harder to predict. Overall, what this interview really communicates is balance. Tom Lee is neither blindly bullish nor catastrophically bearish. He is acknowledging real risks while still emphasizing opportunity. The key takeaway for me is that fear-driven sell-offs are not the same as fundamental breakdowns, and investors who understand that difference are usually the ones who come out ahead when the dust settles. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's talk about the first stock on our list, Duolingo, ticker DUOL, a company that has quietly, yet powerfully, transformed the way the world learns. If you've ever tried to pick up a new language, chances are you've encountered that friendly green owl, Duo, nudging you to keep your streak alive. But Duolingo is so much more than just a quirky app with a cute mascot. It's not just an app with a green owl, it's a movement that's redefining education for millions. Duolingo has become a household name, a symbol of accessible learning, and a daily habit for people from all walks of life. What we're witnessing is a seismic shift in global education. For centuries, learning a new language was a privilege reserved for those who could afford expensive tutors or formal classes. Now, with just a smartphone and an internet connection, anyone, anywhere, can start learning for free. Duolingo democratized language learning, tearing down barriers that kept so many from accessing new opportunities. The app's intuitive design and bite-sized lessons make it easy for users to fit learning into their busy lives, whether they're on a lunch break, commuting, or relaxing at home. The real genius of Duolingo isn't just that it's free, it's that it's genuinely fun and addictive, like a video game. Points, streaks, leaderboards, and daily challenges keep users coming back, turning what used to be a chore into a rewarding habit. This gamification has created a level of user engagement and retention that most educational platforms can only dream of. People don't just use Duolingo, they build it into their daily routines, sometimes for years on end. And here's where the magic happens. The more users Duolingo attracts, the more data it collects. Every lesson completed, every mistake made, every word learned feeds into a massive data engine. This data is the fuel for Duolingo's artificial intelligence, which constantly refines and personalizes the learning experience for each user. Competitors can try to copy the interface or the mascot, but they can't replicate a decade's worth of learning data. This data advantage is a powerful moat, making it nearly impossible for new entrants to catch up. Today, Duolingo boasts over 88 million monthly active users, more than the entire population of Germany. That's a staggering reach for an education platform, and it's still growing. Its brand is now as recognizable as Nike's swoosh or Apple's bitten apple. But unlike those brands, Duolingo's growth has been almost entirely organic, fueled by word of mouth and the infectious enthusiasm of its users. The freemium model is the engine behind this viral growth. Most users start for free, but as they get hooked, a growing percentage upgrade to Super Duolingo for extra features and an ad-free experience. This not only drives revenue, but also keeps the data flywheel spinning faster. Subscription revenue is high margin and growing rapidly, providing Duolingo with the financial firepower to invest in new features, expand into new subjects, and reach even more learners worldwide. And Duolingo isn't stopping at languages. The company is boldly expanding into math and music, applying its proven gamified approach to new domains. Imagine a world where learning algebra or music theory is as fun and accessible as learning Spanish or French, but perhaps the most disruptive move is the Duolingo English test. Traditional English proficiency exams are expensive, time-consuming, and often inaccessible to students in developing countries. Duolingo's test is cheaper, faster, and can be taken from the comfort of home. It's already accepted by top universities around the world, opening doors for students who might otherwise be left behind. The global English testing market is a multi-billion-dollar industry, and Duolingo's digital-first approach is shaking up the status quo. This business line is a hidden gem, often overlooked by investors, but with enormous potential for growth and profitability. So what does Duolingo's future look like? It's a three-pronged attack: a dominant language learning app, rapid expansion into new educational subjects, and a disruptive, high-growth testing business. Each of these pillars reinforces the others, creating a flywheel of growth and innovation. Recently, Duolingo's stock has pulled back, creating what many see as an attractive entry point for long-term investors. Meanwhile, the company is doubling down on AI integration, making the product smarter, more adaptive, and more engaging than ever before. For the first time, Duolingo is now profitable. Its financials are strong, with impressive growth metrics and a clear path to sustained profitability. This is a rare feat in the world of edtech, where many companies struggle to turn a profit. Operating leverage is kicking in, expanding profit margins as revenue continues to climb. Analysts project significant revenue growth in the coming years, driven by both user growth and higher conversion rates to paid subscriptions. Yet the market often focuses on short-term fluctuations, missing the bigger picture. Duolingo is building a global learning platform with the potential to impact hundreds of millions, if not billions, of lives. With a market cap of about $7 billion, Duolingo has positioned itself as a dominant player in digital education, particularly language learning. The company is trading at a price-to-earnings ratio of around 19.46, which is relatively reasonable for a tech-driven platform that continues to expand its user base and monetization strategy. Earnings per share sit at 7.94, showing that Duolingo has successfully transitioned from a high-growth story into a profitable business. In 2024, the company generated roughly $748 million in revenue, alongside net income of about $42.69 million. What stands out here is that Duolingo is proving it can scale profitably while still benefiting from long-term tailwinds like mobile learning, global education demand, and subscription-based recurring revenue. In my view, that combination of profitability and growth optionality is what keeps investors interested, especially during periods when the market starts rewarding fundamentals again. For investors with a long-term mindset, this is a business to own for the next decade. The opportunity to buy into a category-defining company at a reasonable price doesn't come around often. That's why Duolingo is a core holding for growth-oriented portfolios. Its combination of brand strength, data-driven innovation, and expanding market opportunities make it a serious contender for long-term wealth creation. This video is brought to you by the Value Stocks Investing Master Course, your guide to finding the next generation of market leaders. Click the link in the description to enroll and take control of your financial future. Whether you're a beginner or a seasoned investor, this course will help you sharpen your skills and build a winning portfolio. And if you want even more exclusive stock tips and in-depth analysis, join the Stocks Galore Patreon. Our community is growing fast, and we'd love to have you on board. Head over to patreon.com/stocksgalore and become part of a passionate group of investors who are committed to learning, sharing, and growing together. Now, let's turn our attention to our second stock pick, another company with the potential to change the world. Let's dive into the story of Kindryl, ticker KD, a company that emerged from the shadows of IBM to become the largest IT infrastructure provider in the world. In 2021, IBM made a bold move, spinning off its managed infrastructure services business into a new entity, Kindryl. This was more than just a corporate restructuring. It was the birth of a tech giant that, while not a household name, quietly powers the digital backbone of our modern world. Kyndryl's journey is a fascinating one, marked by transformation, resilience, and a relentless focus on mission-critical technology. When Kyndryl first hit the public markets, Wall Street was skeptical. Many analysts saw it as a low-margin legacy business, weighed down by the perception that it was simply IBM's cast-off. Headlines questioned its future, and investors wondered if it could survive in a rapidly changing tech landscape. But what most missed was Kyndryl's essential, behind-the-scenes role. in keeping the world's most important organizations running smoothly. Kindryl is the silent force that keeps the world running. It manages the critical systems and infrastructure for banks, airlines, governments, and Fortune 500 companies. Every time you make a bank transfer, book a flight, or access government services online, there's a good chance Kyndryl's technology is working in the background, ensuring everything operates seamlessly and securely. Their reach is global, their impact profound, and their reliability unmatched. What sets Kyndryl apart is its unique combination of scale, expertise, and trust. With decades of experience inherited from IBM, Kyndryl's teams have seen it all, from mainframes to cloud migrations, from cybersecurity threats to digital transformation projects. Their engineers and consultants are trusted advisors to the world's most demanding clients, solving complex problems and delivering solutions that few others can match. Kyndryl's client list reads like a who's who of global business. They serve over 4,000 customers, including an astonishing 75% of the Fortune 100. These are the companies that drive the global economy, and they rely on Kyndryl to keep their operations running 24/7, 365 days a year. The scale of Kyndryl's operations is staggering, with a presence in more than 60 countries and a deep understanding of local markets and regulations. Behind this global reach is a workforce of nearly 90,000 highly skilled professionals. These are not just IT workers, they are architects of digital transformation, experts in cloud, security, and networking, and problem solvers who thrive under pressure. Kyndryl's people are its greatest asset, and their collective expertise is what enables the company to tackle the most complex infrastructure challenges on the planet. Trust is not built overnight. Kyndryl's relationships with its clients are measured in decades, not years. Many of their contracts are long-term, often spanning 5, 10, or even more years. The nature of their work means that switching providers is costly and risky for clients, creating a powerful moat around Kyndryl's business. This stickiness is a testament to the trust and reliability they've earned over time. Critics often misunderstand the hybrid IT landscape in which Kyndryl operates. While some see legacy systems as a liability, Kyndryl sees them as an opportunity. The reality is that most large organizations run a mix of old and new technologies, mainframes alongside cloud, on-premises data centers integrated with public cloud platforms. Kyndryl's expertise in bridging these worlds is a key differentiator, allowing clients to modernize at their own pace without disrupting mission-critical operations. In fact, Kyndryl has forged strategic partnerships with the biggest names in tech, Microsoft, Google, and Amazon. These alliances enable Kyndryl to offer best-in-class solutions, combining its deep infrastructure know-how with the latest innovations in cloud and AI. By acting as a bridge between legacy systems and cutting-edge technology, Kyndryl helps clients unlock new value from their existing investments while embracing the future. As an independent company, Kyndryl is no longer tied to IBM's product stack. This freedom allows them to be truly vendor-agnostic, recommending and implementing the best solutions for each client's unique needs. Whether it's migrating workloads to the cloud, enhancing cybersecurity, or optimizing IT operations, Kyndryl's independence is a powerful advantage in a world where technology choices are more complex than ever. Under the leadership of CEO Martin Schroeter, Kyndryl has embarked on a bold turnaround strategy. Schroeder's vision centers on 3 pillars: building strong alliances with technology partners, advancing the company's delivery capabilities through automation and innovation, and deepening relationships with key accounts. This strategic focus is already bearing fruit, positioning Kyndryl for sustainable growth in a rapidly evolving industry. The results are starting to show. Kyndryl's operating margins, once a point of concern, have expanded significantly. The company is no longer seen as a melting ice cube, a business in terminal decline, but as a revitalized leader with a clear path to profitability and growth. This turnaround is a testament to the company's ability to adapt, innovate, and execute at scale. Now firmly in the growth phase, Kyndryl is leveraging its unique position to win new business and expand its footprint. The company is capitalizing on the growing demand for digital transformation, cloud migration, and managed services. Every new contract, every successful project adds to Kyndryl's momentum and reinforces its reputation as the go-to partner for complex IT challenges. One of the most exciting areas of growth is Kyndryl Consult, the company's consulting arm. With a multi-billion-dollar pipeline of opportunities, Kyndryl Consult is helping clients reimagine their IT strategies, modernize their operations, and harness the power of data and AI. This consulting-led approach not only drives higher-value engagements, but also deepens client relationships and opens the door to long-term partnerships. Despite generating over $16 billion in annual revenue, Kyndryl's market capitalization remains surprisingly low, around $5 billion. This disconnect between the company's financial performance and its market valuation is striking. It suggests that investors are still underestimating Kyndryl's potential and the durability of its business model. Trading at a significant discount to its peers, Kyndryl is a classic case of market mispricing. Here's a profitable industry leader with a blue-chip client base and a proven track record, yet its shares are valued as if the company's best days are behind it. For value investors, this presents a rare opportunity to buy into a high-quality business at a bargain price. As Kyndryl's revenue growth resumes and its turnaround gains traction, the market is likely to reevaluate the company's valuation. Analysts are beginning to take notice, and investors, who once dismissed Kyndryl as a legacy player, are starting to see the potential for sustained growth and margin expansion. Even a modest re-rating of Kyndryl's shares could result in significant upside for investors. As the company continues to execute on its strategy, deliver results, and communicate its story to the market, the gap between price and value could narrow quickly, rewarding those who recognize the opportunity early. Of course, there are risks. The biggest is that the turnaround could stall, or that competition in the IT services space could intensify. But Kyndryl's progress so far, combined with the stickiness of its customer relationships and the essential nature of its services, provides a meaningful buffer against downside risk. Clients are deeply embedded, and the cost and complexity of switching providers make Kyndryl's position more secure than it might appear at first glance. With a market cap of approximately $5.81 billion, Kyndryl operates in the IT infrastructure and services space, managing complex enterprise systems for large organizations. The stock is trading at a price-to-earnings ratio of about 14.7, with earnings per share of 1.71, which on the surface might make it look attractively valued. In 2024, Kyndryl generated a massive $16 billion in revenue, highlighting the sheer scale of its operations and the importance of its services to enterprise clients. However, the challenge becomes clear when you look at the bottom line. The company reported a net loss of around $340 million. That loss suggests ongoing restructuring costs, margin pressure, or operational inefficiencies that the company is still working through. From my perspective, Kyndryl is more of a turnaround and execution story than a clean growth play. The opportunity is there if management can stabilize profitability, but it also comes with higher risk compared to a company like Duolingo that has already demonstrated consistent earnings power. Investing in Kyndryl is ultimately a bet on execution and a wager against market myopia. It's about seeing beyond the headlines and recognizing the value of a company that is indispensable to the functioning of the global economy. For those willing to look deeper, Kyndryl represents a compelling blend of stability, growth potential, and undervaluation. This is a special situation for value investors, a rare case where a clear catalyst for improvement exists, and the market has yet to fully appreciate the company's transformation. As Kyndryl continues to deliver on its promises, the stage is set for a re-rating that could unlock significant value for shareholders. In a world where so many tech stories are about disruption and hype, Kyndryl stands out as the unseen giant, quietly powering the systems that make modern life possible. The market has overlooked its potential, but for those who understand the asymmetric risk and reward, Kindryl offers a unique opportunity to invest in the infrastructure of the future. So, there you have it. Two tech companies that the market often misunderstands, Duolingo and Kindryl. These companies may seem worlds apart, but both are making waves in their respective industries and could be pivotal for your investment strategy. As you consider your next move, focus on each company's competitive advantages and their long-term business trajectories. Duolingo's brand strength and user engagement are powerful assets, while Kyndryl's expertise in complex IT environments positions it for steady, reliable growth as digital infrastructure needs expand. The big question is, which company has the stronger long-term advantage? Your answer may depend on your investment style and risk tolerance. I'd love to hear your thoughts. Share your perspective in the comments below. Don't forget to like this video if you found it helpful, and subscribe to our channel for more in-depth analysis and updates on the latest market trends. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Thanks for watching, and I look forward to seeing you in the next one. Until then, keep learning, keep investing, and stay curious.